Thanks for clicking. A growing number of Canadian insured mortgages are underwater. According to recent filings by Canada's big three mortgage insurers, Canada Guaranty, Sagen and CMHC. An insured mortgage loan is where borrowers have put less than 20% down and paid mortgage insurance which protects the banks in the case of mortgage default. And an underwater loan is where more is owed on a home than the home is worth. And these underwater loans are a concern for the majority of Canadians. As we'll see, taxpayers are ultimately on the hook if these loans go bad.
What?
The news from the big three insurers comes amid reports of further stresses in Canada's mortgage market, with nearly 1/3 of Canadian homeowners having mortgage amortizations greater than 30 years. So what I want to do today is go over the filings from these three big mortgage insurers, take a look at the number of underwater loans in Canada, discuss Canadians' exposure to those loans, and then take a look at some of the implications for the future. It is the end of the month, so we should start seeing April's real estate data trickle out from the local boards early next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these loans. As mentioned, according to recent filings from Canada Guaranty and Sagen, Canada's two private insurers, and CMHC, Canada's public insurer, a growing number of insured mortgage loans are underwater. As the value of borrowers' homes have plummeted over the past year, their loan-to-value has shot up to the point where their home is worth less than that which they owe.
When you're ready to get serious, give me a call.
Very briefly, loan-to-value measures how much equity is available in a property. So, if a home is worth $100,000 and the borrower owes $95,000, the loan-to-value is 95. If that home is worth $100K and the borrower owes $105K, the loan-to-value is 105. And the disclosures from Canada Guarantee shows that the number of high LTV loans that have an LTV over 100%, has increased by 600% over the past year, up to nearly $4 billion in the fourth quarter of 2022. And that $4 billion in high LTV loans is a big difference from the $532 million that they had in 2021. Sagen, Canada's private insurer, and CMHC, Canada's public insurer, on the other hand, don't report on the number of loans over 100 loan-to-value, with CMHC saying that historically the number of loans over 100 were very low, so it doesn't see the need to report on loans over 100%.
I don't have to explain myself to you.
With that said, the number of loans held by both insurers that are over 95 loan-to-value have increased substantially. Sagen now holds over $14 billion in loans over 95 loan-to-value, doubling the 7 that they had in 2021. CMHC has yet to release its fourth quarter filings, which no doubt increased, but their third quarter filings showed that 2.8% of their loans, or about $5 billion, were higher than 95 loan-to-value. With that said, as a brief aside, it is possible that CMHC doesn't have as many underwater loans as the other private insurers, as, recall, in 2020, CMHC increased its eligibility criteria, after which borrowers fled to the private insurers who did not follow CMHC's lead on avoiding riskier lending. 1 year later, in 2021, CMHC reverted to easier lending criteria as it lost a large portion of its market share to the private insurers.
You're screwed. Thank you. Bye.
So, CMHC did have 1 year of stricter eligibility criteria, so it might not have as many high LTV loans as the other two private insurers. So, Canada Guarantee has over $4 billion in insured loans over 100 loan-to-value. Sagen has $14 billion in loans that have an LTV higher than 95, and CMHC, as of the third quarter of 2022, had $5 billion, and that number has probably increased. With that said, with CMHC being the public insurer, as we all know, the government and ultimately taxpayers are on the hook for any underwater loans and any losses suffered by the banks. So, in the event that there is a wave of defaults and CMHC doesn't have enough money to pay out the banks, the government is ultimately on the hook for that money. But it's not just the public insurer, it's not just CMHC that has the backing of the government. The government is also on the hook for the majority of the loans insured by Canada Guarantee and Sagen, Canada's two private insurers. In the event that these two private insurers are not able to cover their obligations to the banks, if there's a wave of default and the insurers don't have enough money to pay out the banks for their losses, the government is on the hook as well, subject to a 10% deductible, but still the government has to pay up to 90% of their losses. So, in summary, Canada's big three mortgage insurers are all seeing a major increase in the number of underwater loans held on their books. all of these loans which are insured are backed by the government. And I think herein we find at least some of the rationale for the government backing extended amortizations by the banks. If the banks were not offering these extended amortizations which are being credited for Canada avoiding a wave of forced sales throughout the country, if the banks weren't offering these amortizations and we saw a wave of defaults, then the government would be on the hook for any losses suffered by the banks. And politically, I think this is going to be a very sensitive issue should it ever come to fruition, as the government, meaning Canadian taxpayers, are on the hook for these loans that were taken out during the 2020-2021 real estate boom at a time when a large portion of Canadian first-time homebuyers were shut out of the market and are continuing to be shut out of the market as we see the real estate market pop back up again. So these taxpayers were shut out of the real estate market, were unable to buy their first homes, and are now on the hook for those loans that were taken out during the pandemic, which caused the real estate bubble in the first place.
That doesn't sound so good for your whole thing, does it? And
with that said, what happens with the real estate market going forward is definitely unclear. We are seeing some signs of the market coming back to life, which should push property values back up and lower those loan-to-values. On the other hand, OSFI, Canada's banking regulator, is set to release new regulations which could put even more downward pressure on Canada's real estate market, which again would put upward pressure on those loan-to-values, leading to even more underwater loans held on the books of these insurers, backed by the government. We will continue to have updates out on Canada's real estate market, as well as any new regulations coming down the pike from OSFI. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.